Inflation in India is at an all-time high. Inflation in the US is at an all-time high. Crude oil prices have gone up to crazy levels. Petrol is now more than 100 rupee. Russia-Ukraine war has created a lot of uncertainties. Is there going to be third world war? US Fed to increase interest rate. How badly it will impact the US market and Indian market? How much more money will FII pull out of Indian market? Will Nifty tank to levels of 15,000 and below? Hey everyone, my name is Sahil and this is my Personal Finance Academy. Over the last few months, there has been a lot of negativity in the stock market. The impact of this negativity is so intense that the same stocks that were the favorite of every investor a few months ago have suddenly now become unappealing. And the same stock market that was the wealth creator and has suddenly now become a wealth destroyer. It must be depressing, isn't it? Depressing to see your portfolio in red. Depressing to see your stocks not moving in last few months. And I'm sure it creates a lot of doubts in the mind of every investor. Is stock market really worth investing? Especially those young investors that started investing in the bull run of 2021 must be scratching their head. The biggest dilemma would be, should I exit from the stock market? Well, guess what? Whenever I find myself in negative state of mind or feel depressed, there's one quote that I always refer to. And the quote is, "This too shall pass." And as far as stock market correction is concerned, I strongly believe this too shall pass. Sometimes we get so deeply involved in the nitty-gritty of economy that we end up losing our long-term vision. Every day when we hear about rising inflation and the US Fed plan to increase the interest rate and stock market fall, it really makes things very confusing. Hence, I thought of making this video where we will just zoom out of the current scenario and will try to look at the long-term bigger picture of India Inc. I was just reading some article and came across this interview of Mr. Mukesh Ambani. The headline says, India's growth story may be as exciting if not more than China's in coming decades. And we all know how China has outshined in last 3 decades. Just to give you some comparative data points between India and China, in 1990, India and China's GDP was similar. India's GDP was $320 billion and China's GDP was $360 billion. And then over the next 3 decades, China's GDP zoomed to the levels of 14,722 billion, that is roughly around 14 trillion, and India's GDP grew to only 2,622 billion, which is roughly around $2.6 trillion. Clearly, China has outperformed by a big margin. In fact, China was nowhere in the top GDPs in the world during 1990s. But today, it is the second largest economy in terms of GDP after USA. Although India has also grown in last 30 years, but still there's a huge gap between India and economies like China and USA. But here is a silver lining. There is immense growth potential for India to catch up with the developed economies in the next few decades. And if India can grow like China in coming decades, then every investor in the Indian economy is going to create huge wealth. But the question is, can India really grow like China in coming decades? Well, I absolutely believe that what Mukesh Ambani has said about India's growth story is achievable. And in this video, I am going to give you 4 reasons why India can grow like China in the coming decade. Now the question would be, how much wealth can you create in the future? Well, I have done my calculation and it suggests that in the next 20 years, you can potentially generate 10 to 15 times return. Sounds too optimistic? Well, guess what? It is very much possible. And I will show you the calculation towards the end. So watch this video till the end. So the first growth driver for India is its biggest strength, that is demographics. It basically includes the young population. It is the biggest reason why India is among the fastest growing economy in the world and would continue to grow for the next few decades. Try to understand this. If I ask you, what is the most productive age in the lifespan of a person? It is somewhere between 25 to 60, where the person has the energy and skill to earn and contribute towards the economy. Because if you are less than 25, then most likely you would be studying and dependent on others. Basically, you would not be earning. And after 60, you get retired and do not have enough energy to earn and contribute. So 25 to 60 is the most productive age group for an economy, and that's where India is in a very sweet spot. India's median age is 28.7, whereas China's median age is 38.4. USA median age is 38.5, and countries like Japan are growing old. they have a median age of 48.6 and UK has a median age of 40.6. It means these countries are going to struggle with growth in the future due to lower number of productive people. Whereas in India, more than 50% of population is below the age of 25. So for the next 25-30 years, India would remain a highly productive country. Also the fact that now even the women in the country are earning. So a few decades ago, you would have just one member in the family earning and rest all are dependent. But today, it is very common to find both husband and wife earning in the family. Now, not only the median age is in India's favor, another biggest plus point for India is its population. We are a country with 1.4 billion people. What it means is there is a huge scope of consumption in the country. And when I say consumption, it includes everything right from branded clothes to fancy gadgets to spending money on self-grooming to buying cars, building houses, going out for vacation, eating out, and the list goes on. A few decades ago, it was a complete different scenario in India. People would save majority of their money and would not spend on discretionary stuff and experiences. Also the fact that the earnings were very low. But today, the earnings have increased and so is the spending. People like to spend money and willing to pay premium for quality. In fact, things have gone to a different level now. If you look around, there are so many new age fintech companies around your credit card and BNPL, that is buy now and pay later. And they are building a habit of spending more than we earn. Although financially it is not a good habit to spend more than what you earn, but the global trend suggests that credit card industry is going to grow at a rapid rate in India. In fact, there was a study that said that there are only 3 credit cards per 100 user in India, whereas in USA, it is 32 credit cards per user. And credit card industry in India is expected to grow at a CAGR of 25% till 2025. So yes, India's young demographic and its huge population with rising income and spending level is going to create a massive consumption story in the country that would be one of the key growth driver for India's growth. Now, second growth driver would be the increasing government spending. By the way, this video is not politically influenced. I only discuss economy and market. So please don't comment whether BJP is good or bad. So Indian government is spending a huge amount of money on infrastructure by building the roads, highways, airports, ports, rail network and so on. And that creates a huge demand for various end industries like your cement, paint, metal, wire, cable, electrical equipment and so on. In addition to infra spending, Indian government is highly focused towards manufacturing sector. While India has grown leaps and bounds in the services sector, especially the IT sector, the manufacturing ecosystem in India has not grown much. Whereas we have seen how China has become the manufacturing hub of the world. In fact, even India has a lot of dependence on China for manufacturing. As per the report, China contributes almost 28% in the global manufacturing, whereas India's contribution is just 3.1%. But now, Indian government is clear about increasing the contribution of manufacturing sector in the GDP and has launched various schemes like your Atmanirbhar Bharat, Make in India to support the domestic Indian companies. Recently, government has launched the PLI scheme that would incentivize various sectors within manufacturing domain. Moreover, Indian government is also focused towards the sunrise sectors like your green energy production, electric vehicle as well as semiconductor. The goal is to manufacture not only to meet the domestic demand but to become the global manufacturing hub of the world. And manufacturing sector in India already has the young workforce and the right talent. All it needs is government support to manufacture products at competitive pricing which is not available. So I think manufacturing is now one sector that is going to grow leaps and bounds in the future. All in all, the government spending and its focus on infra and manufacturing sector would boost the growth of Indian economy. Then third important driver for India's growth story is the global trend. Earlier, every country was dependent on China for manufacturing. But COVID disrupted the entire supply chain and global companies have realized the importance of having an alternative to China. They don't want to depend upon China anymore. So China Plus One theme has resulted in huge growth opportunity for Indian economy. Some of the sectors that would immensely benefit from this global trend of China Plus One include your textile, chemical, pharma and electronics. Now, fourth big driver for India's growth is digitization. Just imagine, 20 years ago, if someone would have said that you will be able to transfer money to your friend with few clicks within seconds, or buy products sitting at home, or order food, or book a cab, or pay your nearby Kirana store with few clicks, then you would have laughed at the person, isn't it? In fact, who had imagined that one day people would use an app called YouTube to watch videos and learn stuff online? Crazy, isn't it? Especially in a country like India, where majority of people are middle class or below, digitization was nothing short of a dream. But today, you have smartphone and internet in every nook and corner of the country. Today, smartphones and internet recharges are as important as your food, clothes and shelter. And that's a huge transformation. If you look at the data, the internet penetration in India has jumped from few millions just 10 years ago to 622 million people by 2022. And it is expected to touch 900 million people by 2025, growing at 45% CAGR. It was possible because of your low-cost smartphone and internet. And of course, Indian government has a lot of focus on Digital India. Projects like UPI payment has been a massive success all over the country and has added many people into the digital economy. The advantage of this digital economy is that earlier majority of transactions in India were in cash and there was no record for cash transaction. Due to that, people would evade taxes. But now, after GST implementation and launch on UPI payment, many people have now started online payment that can be tracked. Again, I'm not saying that cash transaction is completely stopped, but there's a long way to go. And this digital economy is only going to boost India's growth prospects. So far we discussed various growth drivers for India Inc. But you might ask, Sahil, this is all fine, but how does it help an investor grow its wealth? So the logic is simple. If Indian economy would grow, every sector would grow and eventually your investments would grow. And think about this. A few years ago, people would fetch 8 to 9% interest on FD and other fixed income instrument. It was even higher in 1990s and early 2000. The fixed interest rate were in the range of 10 to 12%. But look at where we are now. We hardly fetch 5% interest rate today. And if you fall under 30% tax bracket, then your effective return is just 3.5% and inflation itself in India is 5%. So net if you keep money in fixed instrument, then you are shrinking your wealth. What options do you have? Real estate is not anymore a lucrative investment. Real estate rates all over the country have gone up crazily. So there's nothing much in terms of return potential. Also, real estate is not a liquid investment. That leaves us with only one option: investment in the stock market. It could be done via stocks or mutual funds. Hence, I believe that going forward, there is going to be huge amount of investment in Indian economy, both from domestic investors as well as from foreign investors. To be really honest, if you are a young person, then consider yourself blessed to be born in a country like India at the right time. Because in the next 20-30 years, India is going to grow at a very good rate, and if you remain invested in Indian economy, then you will create a lot of wealth. Now, how much wealth can you create? If we consider a 12% CAGR return over the next 20 years, which I believe is very much possible, then you will end up generating 9.6 time returns. So 10 lakh today will become 96 lakh. You can open any calculator and check the calculation. Now, where to invest to fetch this 12% return? If you are someone who doesn't know anything about investment, then simply invest in Nifty 50 index fund. That's it. You are sorted. Of course, you can always add flexi-cap fund or have some diversification in global market. And if you invest in quality stocks, and let's say you end up generating 15% CAGR return, then your wealth would grow 16.3 times in the next 20 years. That's the power of compounding. In short, there is immense growth opportunity from here. Don't just worry too much with the current volatility in the market. Remember, this too shall pass. In fact, utilize this opportunity to invest at discounted level until the next bull run. So this is it for this video. If you find it useful, give it a like and share it with your friends. And tell me in the comments, do you agree with India's growth prospect or not? And did I miss any key growth driver for India's growth journey? Also tell me which financial topic you want me to cover in the future. If you want to learn more about investment, you can explore my online course on money management. I'll see you in the next video. Till then,